And we are live. It's your favorite insurance agent, Darnold Jr., and this is FinLit Live, where we get literate about finances. And I have a very, very special show for you today. If you don't like paying taxes and you want to know the legal way to get around paying taxes, this is the show for you. So definitely tune in and let's get lit. All right, today I have on the show a very special guest. Her name is Lindsay Davis, and without any further ado, let's go ahead and bring her on. Hey, Lindsay,
Hey
how's it going?
guys, pretty good. How are you?
Welcome, welcome to FinLit Live. Thank you for taking time out of your busy schedule to talk to us about a very, very interesting topic. It's something that I've actually been hearing a lot about lately, about how literally billionaires are not paying anything in taxes, and it's kind of curious as like whoever has the gold makes the rules, right? And so they're the ones
Yeah.
that make the rules, so they don't have to pay the gold, right?
Yeah.
So it's going to be an interesting topic. But before we get started, go ahead and tell us a little bit about yourself.
So as you know, my name's Lindsay Davis, and I work for the Fitzpatrick Group. And our company has been around a little over 5 years. But the founders of our company have been in the industry for near 20 years. And we just saw how there was a lot of misinformation in the financial industry and how there needs to be more transparency and more math that really needs to be done, honestly. And we focus more on the back end education, what's going to happen during retirement, which, of course, taxes is going to happen. So that's the main thing I'm going to talk about today.
Excellent. So it's a very, very exciting topic. So I'm curious just to dive in. Let's go ahead and dive in. So yeah, so what are you referring to? What are you alluding to? What is this retail versus ideal portfolio? Tell us a little bit about that.
Yeah, I'll dive right in. So first, I'm going to go over your typical retail portfolio, what we call retail portfolio. And that consists of maybe an old IRA, a current 401k, maybe a brokerage account, some fund money. And then some people have pensions or real estate. And then there's Social Security. So I asked most people, how did you get into this type of account? Because most people have something or multiple of that for their portfolio. And most people don't know that there was the 1978 Revenue Act. And we tell a joke that Congress and Wall Street and the devil all got together and said, if you push people into these accounts, we can charge them fees, which is current revenue for the IRS. But then, since you're deferring your taxes, that's a future tax revenue for the IRS.
Mhm.
Because with your IRA, when you distribute out of that during retirement, you're going to be paying income tax. When you take out of your 401k, that's going to be income tax. Depending what you're doing with your stocks, it can be income tax or capital gains is long term or short term. But then pension, that's going to be income tax. And if you have real estate in your portfolio, if you're renting, that's going to be considered income tax. And then if you're showing a certain amount out of all these accounts, the IRS has what's called means testing. And most people don't know what means testing is or never heard of it. And so if you if you show over $45,000 coming out in retirement, whether it's just you as an individual or even you as a couple, I'd hope most people are pulling out more than $45,000 in a year for retirement. The IRS looks at that and says, well, we can tax your Social Security up to 85%, and that's double taxation, and it's ridiculous. So um, this Revenue Act just basically set us all up to be pushed into these accounts so that the IRS can get their way, and nobody's really going to know the way around of the means testing, and they're going to have to pay these extra taxes on top of the taxes you already have to pay. And so I typically ask people two questions. Where do you want your income to go in the future? Do you want it to go up or do you want it to go down? And most everybody says, and everybody says they want it to go up, which of course. Next question is, well, what do you think tax rates are going to be in the future? Now, none of us have a crystal ball, right? But with the state of our country, the amount of debt, we can only assume taxes are going to be higher in the future. So, um, what happens when taxes go up? Usually that means there's less money in circulation, right? And so when there's less money in circulation, what typically happens to the economy? Well, that goes down as well because there's less spending. So if you're in market-based accounts, you're totally affected by that. And just because your market-based account goes down, does that eliminate your tax liability? Absolutely not. Does that eliminate the fees that Wall Street charges? Absolutely not. And so what we like to tell our clients about is what I like the ideal portfolio. And so that consists of investment grade life insurance, which there's good and there's garbage. And you absolutely have to know the difference because it's arguably the most powerful asset on the planet. The next thing is Muni Bonds. Not doing anything fancy right now, but a good 1 to 3% on a Muni Bond could be worth somebody's 3 to 6% on their mutual fund wrapped in their IRA. And then another piece to this is individual stock. But the twist we put on that is you always want to keep your tax liability under your deduction so that you can wash that gain. So we talk about how Warren Buffett doesn't own mutual funds or target date funds or index funds. He owns individual stock and he holds it long. And so why aren't we doing what he's doing, right? Because if you can mess with individual stock and have your sell off your equity lower than your standard deduction, or some people have individual deductions, you can wash your tax liability. So when we look at this, when we take out of these type of accounts that are in the ideal portfolio, we could take out of the investment grade insurance, which is tax exempt, which is better than tax free, because there's not even a line for it on your tax return. You could take $100,000 out of there, and then with a Muni Bond, you can take $100,000 out of the yield of that, and that's tax free. And then you can also, and I forgot one major one, is also anything Roth. And most people are familiar with Roth. So there's a traditional, there's a Roth IRA, Roth 401k. There's also backdoor Roth. And so let's say you're pulling out of your Roth $100,000 tax free. And then let's say you took $20,000 equity out of your stocks and made sure it was under your deduction for the year. That's $320,000. And what tax bracket are you in with pulling out of all those type of accounts? Zero. Because everything's coming from tax exempt and tax free, and then you're making sure when you're messing with your stocks that you're staying under your deductions so that you can wash that bill as well. And so we have so many clients that are retiring off hundreds and thousands of dollars, paying little to no taxes in the ideal portfolio. And then we have clients retiring on significantly less, paying significantly more in taxes. And so our goal is just to educate people on the back end liability of the type of accounts people are in now in the retail portfolio, and to see how we can get clients to shift into the ideal portfolio as much as possible. So
Excellent.
that that's that's the main overview. It's a lot of information, but of course, with financials, everybody's situation's different. So sometimes we can't get clients all the way into the 0% tax bracket. But if we can get a client as close as possible, then we've done our job, because nobody wants that huge tax liability when you're supposed to be enjoying retirement.
Absolutely. So you did got a lot of great things there, and so let's digest this a little bit. So not all our viewers are necessarily financially savvy, so we got to break it down a little bit. So you threw out a couple terms that I want you to clarify. One of
Mhm.
them being Muni Bond. I know what it is, but can you break it down as far as what is a Muni Bond? You actually use the short phrase for it, but
Yeah, I guess I did kind of like abbreviate basically. But a municipal bond is anything from your local government. And so since you're um, dealing with the government, and like say there's a project they want to do for new roads and you help, that, um, anything that's earned from that interest, that's tax free, and it's called a municipal bond. So it's not your typical bond, but since it's tax free, that's why we like it.
uh so you said you could take out up to $100,000 of yield on that.
So I just used those numbers as an example of how things are distributed during retirement. Of course, the actual number is going to depend on, the dollar amount of your account and how much people are investing in these certain type of accounts. So I just use that as an easy math example of you can pull X amount out of all of these. And even though that adds up to 320,000 in my example, you're still in the 0% tax bracket because of the sources that it comes from. And since you're
Wow.
showing zero, that you're not pulling from these taxable accounts, depending how that's done, you bypass that means testing that I talked about from the IRS, and you should be able to get your full Social Security benefit.
So is there a limit on how much people could invest, like in muni bonds and investment grade insurance?
So specifically with investment grade insurance, there's a lot of education behind it. So short answer is there's not really a limit, but people start thinking they can do all kinds of things with that, and it still has to be something that's structured with an amount that somebody can still save on a monthly or yearly base. And it's not something that you can be like, oh, I have this lump sum of money I want to throw in there one time and let it sit. It works a little differently. So that would be more of a case by case education type thing.
Okay. So they would have to consult with you, in other words, right?
Yes, for sure, because um, a lot of people try to go on Google and, look up investment grade life insurance, which really that's just a marketing type term. Um, because there's certain components that makes a life insurance contract actually investment grade compared to other type of products that are out there, um, that are whole life products, but they are structured in a totally different way that we would not consider investment grade, and we would not own them ourselves, and we would not want anybody else either. So there's a lot of bad things revolved around life insurance. And I would agree with most all the bad things I hear about life insurance, because unfortunately there's a lot of bad products on the market, um, which is not good. And then of course that kind of turns off people from even hearing this strategy, because they might have heard about a bad whole life product and don't even take the time to listen to what kind of strategy this really is and how it really works, because we break down the math from the start to the distribution part to the total asset. And there's not many agents out there going through the whole entire thing and what's going to happen on the back end. There's a lot of agents out there that'll show you a whole life product and they're like, look, this is a good asset, it's going to make you money, but then they're not talking about the fees that are involved. A lot of them have fees that keep rising throughout the policy, and then what happens at the end, it ends up eating away at the cash value, and then clients will get a bill in the mail after they've had it for years when they're older and thinking they're going to pull money from it, but then they get a bill in the mail that they have to pay X amount of money to keep the policy going, and they're like, what? I don't understand. But what they didn't realize is the policy was eating the cash value as it went, and it's a horrible thing that there's products out there like that. Um, but but that's kind of the misinformation. Well, I guess it's not misinformation because those actually exist, but we're counteracting these other products with other type of education on other type of working products.
Awesome. Can you still hear me okay? Because my screen's freezing actually.
Yeah, you haven't I haven't seen you freeze on my end.
Oh, cool. So what type of books would you recommend?
So I have a couple favorite people, and one is Garrett Gunderson, which I have that to show. What would the Rockefellers do? It's an awesome book about taxes exempt strategies and what they did to create their generational wealth. And then there's another one called The Volatility Shield by David McKnight, and he also has one called The Power of Zero. Anything by them is awesome because they have multiple books, and they're great reads to dive into the tax exempt strategy.
That's awesome. Sounds like great books to read. Which one will you
Yeah.
read first, since you've got a couple of recommendations?
Well, personally, I read The Volatility Shield first. Um, it's kind of interesting how he wrote it because it's telling a true real life story while teaching you about it. So it's kind of interesting. But if if you're super interested in the strategy, I would probably start with what would the Rockefellers do.
What would the Rockefellers do? That's awesome. That sounds like a
Yes,
cool title. It's like, what would
it
Jesus do?
is.
What would the Rockefellers do?
Yeah. What would the wealthy people do?
Exactly. Excellent. So if anybody that's watching has any questions, feel free to type in the chat any of the questions you have. And while you are doing that, I'm going to say, how can people get a hold of you if they're interested in developing these tax exempt strategies and have securing their future where they don't have to pay it all to the IRS?
So the best way to reach me would be my email, and it's just ldavis at fitzgrp.com, and that's Fitz FITZ GRP.com.
Excellent. Cool. So I appreciate you once again for being on this show, and hopefully we can have you on in the future, because I bet you're going to have a lot more tips and tricks for us on how to save on taxes in the long run.
Yes, thanks for having me. This was great.
Yes. Well, I hope you have an amazing evening, and I look forward to speaking with you soon.
You as well. Thank you.
Oops. Hey. All right. Well, if you got any value out of today, definitely go ahead and smash that like button. Share this with your friends if you know people that are in that stage of planning on retiring, or even if you're at the beginning of life and you haven't even thought about retiring, this is a perfect show to get started, because nobody wants to pay as more in taxes than they have to. There's a lot of legal loopholes in the tax law that will help you to be tax exempt. So definitely share this with information with people. And so with that, the reason I started the show is because I felt like I wasn't getting financial literacy growing up. A lot of tips and tricks that you heard on tonight's show I never heard before in my life. And so it's cool that I get to interview a lot of amazing people and get value that we could add to you guys and to myself. And the where the rubber meets the road is application, though. We got to be teachable and willing to add these strategies to our portfolio and to our lives, and that way we could be on the other side of wealth and be at the high end where everybody wants to be, right? So with that, subscribe to my YouTube station, Finlit Live, and you can find it on finlitlive.com. And with that, let's continue to get lit.